I don't know why Rigetti's up, but I'm willing to leverage up to short it. Leveraging always goes right? Never goes wrong. Especially when you use a lot of it. It's intelligent leverage. It's like MicroStrategy leverage. I don't buy puts, man. I really don't buy puts. Yeah, you know, you're better off if you don't use options, just in general. Just short the stock. The more you constrain yourself to profit, like it's like, okay, it's hard enough to get the stock to go down and you make money. But now it's like, no, I need it to go down by this much, by this date. It's like, okay, why are you making this 100 times harder for yourself? I want to make more money. I need 100x. And then even then, I'm still in debt. When I worked for a big hedge fund, we never used options. What's the point? You can express your opinion with stock. It's all delta in the end, baby. When you give your money away to Jane Street, you no problem. I only made 10 billion last year. Renaissance only made 10 billion as well, you know. Keep throwing your money away. 2 Sigma will take it, Citadel will take it. It's absolutely. Yeah, SBF's just bad at chess. Like, that was the real problem there. Is that, like, this guy has always had this Dunning-Kruger problem. Massive Dunning-Kruger problem. I don't know what it is that he's good at, but, like, he's bad at chess. He's bad at League of Legends. He said that reading books was a waste of time. This is a really, really interesting take. That's like, nobody's ever said that. And now, of course, he's reading books. Look to, like, a weak chess player. He's basically like, oh, I'm 1400. I think I'm great. And then he loses to somebody who's 1200. And he's like, oh, my God, they're really good. Honestly, so, like, I'm going to say this is terrible, what I'm about to say. I grew up in, like, kind of a rough household where my parents were very physically disciplining everybody, including each other. Wasn't happy. It wasn't a happy place. But let me tell you something. It taught me a lot. And SBF, I think growing up, he could have used a smack or two. I hate to say it. The Albanian way of being brought up might have done him a little good. Listen, we're going to make you a man, all right? Come here. It's a terrible way to do things. It's terrible. But I never would advocate for that. It made me, give me a lot of anxiety, made me very, probably added a whole bunch of different elements to my life that I didn't like. But, you know, you don't want to have your kid end up thinking he's the hot in the world because he knows how to move. You know, he knows 3 openings and 2 tactics lessons. This is a participation trophy era. I'll never forget this one thing. I was in the library, right? You know, I grew up in this, in sort of this weird nexus of Brooklyn between Flatbush, which was the black neighborhood, Midwood, which was a Jewish and Russian neighborhood. And basically, I would go to this library a lot. I mean, a lot. It's a good library, actually. There'd be a lot of, like, Orthodox Hasidic kids there. I checked out a stack of books, and I was, you know, little kid. I was probably 4 feet tall. I had a big stack of 10, 12 books. And the kid next to me is with this Hasidic mom. You know, they have their ceremonial dress. I think the kid's got his curls. He's got his yarmulke. And he's got, like, his books, too. And my mom says, his pile is bigger than yours. Get some more books. You know, my mom, of course, you know, graduated, you know, 3rd grade, but still knows enough to, you know, had to give you that competitive spirit. Anyway, the point of the story is you're supposed to reward real achievements and you're supposed to look down on disappointments, but you're also supposed to provide encouragement, but not too much encouragement. So if you end up in a situation where you reward achievements and you reward failures and you're never disappointed, I don't know how he was brought up, but that much Dunning-Kruger only can come from sociopathy, you know, extreme autism. I don't know. It's just bizarre. That's the Asian. You'll never find an Asian with Dunning-Kruger, ever. That's the Asian strat, the Asian father meme. You go to spelling bee? Why spelling A? Why not spelling A? You're allergic to bees? Oh, good. You'll never get a B. You know, Dunning-Kruger comes from I think like a place of just being told you're special all the time. You know, it's not healthy. That's I think it's it's not like one of the worst sins you could have. I mean, it's not that big a deal, but it is like super embarrassing. This is so weird. I typed Sam Bankman-Fried, Sam Bankman UCSF, and it made up his Google completely made up his background. He never went to UCSF. First of all, UCSF is a grad school, bachelor's degree in physics. When you buy premium, you know, you really need a miracle for it to work out. when you say you heard something, like unless you're in the geopolitical sphere, you didn't hear it. You read it somewhere online, right? Unless you're friends with some ambassadors or some spies, you tell us, I read it on 4chan, or I wish I was locking in profits. Come on. Rigetti is like a biotech company. They don't make money. They hope to make money someday. And again, there's nothing really fundamentally wrong with that business model. It's just, I think the ideal way to do this kind of thing, it's easy to say after the fact, right? But I say this all the time, is that if you're shorting a stock that's sort of doing this, and you are here, or maybe you are here, the best way to do it is to do a negative 1% position. Why? You might say, Martin, that's too low. I'm not gonna make any money if I have a negative 1% position, am I? Wrong. Absolutely wrong. Because if this stock goes down right away, right? So the bubble is over. This was the bubble. We zoom in and we say, this is the bubble. And this is what happens. It just drops right away. Well, guess what? You make 1% or whatever, 50 basis points. But let's say you make 70 basis points. Now you say, I'm not going to get rich with 70 basis points, right? That's not right, because you made that in a week. 70 basis points in a week is 1.007 to the 52nd power. That's a lot. That's 44% a year. Pretty good. Let's say the thing goes up quite a bit on you and you're pissed. Well, this price, your 1% short is now a 2% short. But let's say you double it up. Say it's 4% short now. And in a new scenario, it also tumbles and drops a bunch. Well, remember, you are down 1% already on your short. So you're going to recover that, but you're going to make, well, I guess you could just say, how much does it go down? Say it goes down to, I guess you would make, who knows the number? It's a little tricky because it went from negative 1%. So let's say it was $50,000. Then you lost 50K because it was 100K here, but then you double down with another 100K. Let's argue. And this goes down 70%. So you make 70K on this. And this goes down 70%. So you make 70K on this, but you were down 50K on this. You really only make 20K on this. So, okay, so you make, let's say 50%. So you make 50%, which is great, obviously, on a trade. 2% in this case on your whole portfolio. And let's say that took a month. Well, 1.02 to the 12th power is also a very good return. That's 27%. And, you know, these are just examples. You can. So let's say this really crushes you. It goes up to negative 8% or something. So now you are down. Well, this 50K is doubled twice. So this is 200K and you're down 150K on this one. And this 100K has gone up to 200K and you're down 100K on this one. You're getting close to your maximum pain. But you say, I'm going to keep shorting it. I'm going to add another 4%, which is another 200K. So I'm going to grow my position to negative 12%. Remember, the short is growing without you. This is month 2. And, you know, you time it. Eventually the stock's going to drop, right? So here you time it well and you make 75% again. So 75% of the down is this 150, this 200K goes down to 50K. So you break even on this guy. This 200K partial investment goes down to 50K. So you're up 50K on this guy. 50K is 1% in our world here. And then the 200K you shorted here does really well. So you're up 2% in this one. So in this scenario, you make 2% for your portfolio. You took a lot more risk though. You know, it's a lot less return. And then finally, you know, if you're super unlucky and the worst possible thing happens, and you know, you want to separate these maybe more widely, I don't know. This is literally surviving a double, another double, a third double. So I don't know if Rigetti was $1. Nobody shorted it at $1, right? So let's say you maybe got interested at $2. We really got interested at 4. So let's look at 4. So this is surviving a 4 to an 8 to a 16 to a 32, which is not what happened here. So this is 3 doubles. First double is here. The second double is here. And the third double is here. So if you got 3 doubles, you are now at 24% position. That's pretty disastrous, obviously. but you decide to go all in again. So this 24%, you're basically all in at this point. Again, not something I would necessarily recommend, but this part makes you 18%. And this part should, roughly break even. But let me see. Actually, you would lose money on this part. So you lose 50K in the first part. This guy, 100 turns 200 to 400, back down to 100 would break even. And then the 200 to 400, so you'd make 50. Okay, yeah, so you'd break even on that. You'd sort of make 18% in, say, yeah, this is martingale for sure. But the point is that you're leaving room to live, which is great. So depending on how you do it, let's say that took 6 months, you would make 39%. So the point of my story here, and this is sort of a tiger approach, is that as long as you're certain it's going to go down, and as long as you keep your sizing right, you should be able to survive. And in this scenario, we are literally doubling our position size after 3 doubles, and we still survive. You could also decide to start shorting it when it goes down, which is a popular strategy. Either way, the biggest mistakes in money management come from positions that are way too large. Yeah, so the lower you start with, the more room you have for error. Look, I'm not even talking about stop losses. I'm not even talking about, waiting till it peaks and then shorting it. Those are all really good strategies too. But at the very least, if your plan is I'm going to fight this through to the end, you can't start with a huge position. Yeah, I mean, I'm not saying I know the perfect answer. All I'm saying is that if you pile into a short because it's the best short you ever heard, but it's super volatile, you should sort of expect the possibility that it can go up, it can double even twice. And if you can survive a 4x on a short, you should probably, you'll make money. But some people need to be able to survive a 10x or a 20x on a short. It all depends on what your objectives are. That's a problem. I do think you have to be willing to abort ship too. A good time to abort ship here was when, like if I was a more risk-averse investor, which I'm obviously not, a good time to abort ship was when Microsoft said it was going to be the year of quantum. Then it was like, okay, Google's in here, but now Microsoft's making noise. Man, this is too, let me wait. And again, that's hindsight. I'm George Soros, but that doesn't help me today. I think, the thing Paul Tudor Jones, but Paul Tudor Jones says the mistake he sees almost every new trader make is their position size is too much. I knew a guy who worked for Steve Cohen a long time ago, early days of Steve Cohen, when there was only 50 or 100 people. Okay. And, he had a 20-year track record. Okay. Q1, Q2, Q3, and Q4. And this is his track record. And this was the year. Okay. Now people have monthly track records and stuff like that. But the way he sort of liked to present his track record was like this. Right. So let's say I made 5% this quarter. I made 3% this quarter. I made 6% this quarter. I made 4% this quarter. I was up 20% this year. You get it? And this guy's, he's well known in the hedge fund circles. He's not too well known outside of it. He's been retired since he was 40. I worked out at this guy's office briefly. And, he was a friend. We sort of just don't talk anymore. No bad reason. I'm sure he would have no problem hearing from me today. So anyway, here's the thing about this guy's track record, right? So this is his 20-year track record. Every single quarter for 20 years was positive. Every single quarter, 20 years. Never had a down quarter. And there were plenty of recessions and depressions and things like that in that quarter. So you might say, okay, sure, he's a great investor. There's a lot of those, right? But here's the thing about this that's special. Obviously, the track record itself is special. It's pretty rare. Very rare to have that kind of track record. There are other people that have that track record. But here's what's interesting about this guy. He never had leverage once. And this was really weird. I worked at his office, so I kind of got to look at his portfolio sometimes and talk to him about this stuff. He always had half of his portfolio at least in cash. And in fact, he often had 70% of his portfolio in cash. So there's many ways to skin the cat. When a lot of people take leverage, they're thinking in their head, well, I need to do this because I need to come up. My account's X dollars and I want it to be 2X dollars. Well, of course we all want that. But the problem is, as you make mistakes, those mistakes will be magnified. This guy, no, he wasn't short. He was pretty neutral. This guy made a trade. He was sure he was right on a short-term basis and a long-term, whatever. He was mostly a short-term trader. Exactly, 𝗕𝗂𝗢's got it. He only swung at perfect pitches. And if you only swing at perfect pitches, or what you think are perfect pitches, I mean, you will basically, the ones you get wrong, because you will get them wrong anyway, right? You're just going to get stuff wrong if you're a trader. Buffett doesn't necessarily get a lot of stuff wrong, but Buffett makes two investments a year. So it's easy for Buffett. This guy's making, 100 trades a day, maybe like, 30 to 100 trades a day. Cramer was a lot like this too. Would buy a stock in the morning, and by the afternoon, if anything felt off, he would just sell it and just say, I'm out, I'm too nervous. He couldn't take any amount of money as a loss, basically. Any position was not working for him, he's out. I have a very different strategy. I'm more like an Appaloosa or a Tiger where I'll take all the pain in the world, bring it on. I don't care. And that strategy works too. But the question is, if your strategy isn't working for you, think about a different strategy. Think about, okay, let me take much smaller positions. Let me see if I can grow my account that way. Because at the end of the day, as long as you're growing your account, that's what matters. You just want to avoid shrinking your account. The rate of compound return will take care of everything else. The law of compound returns. But if you're shrinking your account, you can't do much. You can't become rich, that's for sure. So I think that, you got to find a way to grow your account. And if you've tried and tried and tried again, taking these big swings, trying to be a hero, and it's not working, try smaller swings and try strategy where you automatically, any position costs you whatever the number is for you. It could be $100, it could be $1,000, it could be $1 million. Whatever number makes sense for you, you just say, I'm out at this amount. I don't care what it is. Now, of course, if you have complex positions like hedges and things like that, you probably want to think about how to make this method work for you, including some of those things. You make adjustments, you make it work for you the way that makes sense, but you don't want to be sitting there frustrated and then repeating the same thing that got you frustrated in the first place. That's, the definition of insanity, I guess. You're gonna have the same outcomes. Now, the funny thing is, in different markets, different strategies will have different outcomes. So you might say, well, I used to do this and sometimes it worked. Well, sure. Mean reversion works really well in certain markets. Trend following works really well in some other markets. I think that to find a system that works well all the time is very hard. Very, very hard to do. And part of it is mastering your own psychology. I mean, what system are you compatible with psychologically? But I think, maybe the number one thing about any system is that you just have to be comfortable with its rules. What you probably don't want to do is say, well, I'm a trader who will fight a position and I'll double down as it goes up. But then you don't want to be the guy that then starts scalping for quick profits. You sort of have to be consistent. You can't take one part of a strategy and then decide that you're going to take something that's diametrically different for your strategy from Monday to Tuesday. You have to be really consistent and say, this is how I do battle with the market. I'm a trader that, has really tight stop losses, and I try to get as much gain as I can, but I always obey the stop loss. That's my thing. Or you could say a strategy like mine, which is I try to find my true north, my lodestar. I have my opinion about what a company's worth, where it's going to end up, and that's the North Star I follow. I don't care what else happens. The market's just noise. It's nonsense. My lodestar, my true north is what matters. But then you can't mix them up and say, well, my true north matters, but when it's up 5%, I get it. That doesn't make any sense. Because you'll never make it. It'll sort of always be, the market will always be chopping you up if you act that way. Every 5% in the stock is going to make you nervous. It's going to drive you crazy, and it's not going to work. So you really have to find your strategy that makes sense. Other people say, I need an edge. I need an informational edge. Okay, well, you're playing with fire with that one, but that method does work if you can get informational edge. You don't need insider info per se, but you get closer to the line. And, it's a game some people want to play. There's other people that say, I just want arbitrage. I don't think, Stoicism is good for some people, but for other people, you might want to be so the guy I was talking about with the perfect track record, this guy was well known for being a very loud, very angry screamer on the trading desk. He was a perfectly nice guy outside of the trading desk. But this guy also worked for Michael Steinhardt, who's the godfather of screaming at people. And, basically, Steinhardt would yell at people. Cramer worked out of Steinhardt's office for a little while. Steinhardt was like the god of hedge funds back then. Steinhardt would just start screaming at the top of his lungs at anybody and anyone around for a small loss. And I think the guy's super rich, right? The reason for screaming is not because he's mad at losing the money, even though it might seem like it. I think the reason for screaming was just to get the loss internalized as a mistake and cut the mistake and move on. Because if you start to accept the losses as a trader, you're basically cooked, and that's kind of the philosophy that this guy I'm mentioning, I won't say his name, Steinhardt especially, and then also Cramer and many others, that was their strat, was to sort of lose their minds, screaming, yelling, breaking things, just to reinforce that discipline. I think that I can't lose money. I can't lose money in any trade. It's terrible when I lose money on any trade. So if I'm up 30% for the year, a good way to be up 10% for the year is to start accepting losses. And I accept losses, but that's because that's my strategy, is that I'm willing to accept losses in the short run for gains in the long run. That's not a trader strategy. A trader strategy is I'm never going to take losses. I'm never going to have a drawdown because I'm always going to be out. Now, a trader has to take some amount of pain, but a trader, the way I'm describing it, a Steinhardt-like trader, it's not willing to take much pain. They're not willing to have months where they're down more than 1 or 2%. I'm willing to take almost all the pain until I get proven right. And again, that's a very Tiger perspective, but Tiger had its pros and cons too. So, it all depends on your strategy. A lot of traders will have a hard time making a 50% return for the year because they're scalping smaller moves. They're taking less risk, really. Guys like me don't have that big of a problem, but we also might have a year where we're down 20, 30, 40%. It's all in you. It's all in you trying to figure out what you want to do, where you want to be, how you want to do it. And I think the number one rule is stick to your strategy. Doing things inconsistent with your strategy, you have a problem. Now, listen, if you are shorting NVIDIA and Palantir and you're buying cassava, you're not going to make money no matter what your strategy is, right? So you still have to have alpha. You still have to be right. I mean, that's never going to change. So skill makes things a lot easier.